Hello and welcome to The Upside. I'm Kyle Sharapita. Thank you for joining today's show, where you'll hear from Fidelity's top voices and clips from our recent Vision Plus event. Fidelity portfolio managers and subject matter experts hit the stage at the Metro Toronto Convention Centre to share their thoughts on 2025's market environment and how this environment may impact their individual strategies for their portfolios. We welcomed thousands of advisors watching live online. And now, post-event, we're pleased to offer a replay of the full event for advisors on fidelity.ca. And for our audience of investors, you can watch video podcast replays of select sessions on YouTube, Spotify, or your favorite podcast app. So today on The Upside, we'll feature highlights from the day, starting off with David Wolf and our global asset allocation team, who touches on the market surprises seen this year, how the GAA team reacted, and the benefits of staying invested in a diversified portfolio.
The thesis that we coalesced around was the market was priced for maximum US exceptionalism just at the point where the new administration seemed intent on undermining the things that made the US exceptional. And that's fundamentally rule of law, property rights, stable and strong institutions, predictable governance, all of these kinds of things. So we acted, right, as you know. We sold a lot of US assets in the first quarter, US equities, US treasuries. We bought Europe, we bought Japan, we bought gold, we bought inflation-protected securities, we bought some liquid alternatives. So we were very much of the view that the US generally, and the US equity market in particular, was in trouble, and that we needed to get out, and we took steps to get out.
Yeah, it's really interesting. I mean, I think about last year, we spent all of last year talking about exceptionalism, right? This is exceptional just in a different way. I mean, so the natural question I think that a lot of you are thinking right now is, well, why didn't you do more? Why not more?
Yeah, so, I mean, it's a totally fair question. And, you know, in the limit, and I've had folks come up to us to ask this, is if you thought things were going down, why didn't you just go all to cash, right? And the answer there is, and this, by the way, I'll spend a couple of minutes on this, is probably going to be more important in terms of all of our businesses than anything we talk about with respect to the macro, the outlook, what have you. So if you want to go all to cash, you actually have to get two decisions right.
Yep.
The decision when to get out and the decision to go back in.
Yep.
And even if you're lucky enough to do the first one, the second one is really hard too. In fact, I don't know anybody who's reliably good at getting both of those right. And I know a lot of people who are reliably bad at getting those right. And I think, a lot of folks in the audience will relate to this, that, a lot of individual investors in particular who are emotional will sell at the wrong time and buy at the wrong time. And it's this sort of behavioral drag where a client's experience actually falls short of just the fund returns because you're in and out at the wrong time. So I'll give an example of how all of this works. So let's say Trump was elected. You are of the view that, hey, everyone is wrong.
Yep.
This is not going to be great. This is going to be terrible. I need to get out of the market.
Yep.
So when do you do it? Do you do it when he was elected, when he was inaugurated? And let's say we split the difference. You wake up on January 1st and said, this is not going to be the great year that everybody says it is. I'm going to go all to cash. If you had been in cash, you would have ducked, obviously, the volatility, but you still have a problem. Is here where you get back in? Is it 10% higher? Is it 10% lower? These are questions that you don't have to answer if you stay involved and stay invested in a diversified portfolio. And I've always thought, and many of the folks in the audience have known me over a decade in running these funds, for all that we do in terms of active allocation and generating outperformance, maybe the biggest part of the value proposition is if you're diversified, it helps people stay involved, stay invested. It ultimately is going to be good for everybody.
So now, to build off of what David Wolf said, portfolio manager Patrice Quirion runs several global funds and has been talking about the shift in market leadership away from the US for quite a while. Here are Patrice's thoughts on tilting towards Europe and China, among others, to support his thesis of advocating for international markets.
Great to be here with all of you at the really interesting time, I think, not only in terms of making sense of all of what's happening on a geopolitical basis, but exactly to your point, I think there's certainly a scenario, like at the minimum, where we are assisting to something broader underneath the surface of that volatility. I've been advocating for quite some time. You can look at the positioning in my global portfolio, which has been heavily tilted towards Europe, China more recently as well, at the detriment of having a fairly large underweight position in the US. And my thinking, and this is prior to what we're witnessing since the beginning of this year, but the thinking was that if you look at the main drivers of an economy, the consumer, the corporate sector, and the government, so the fiscal side, and you try to plot it on a cycle of where are we in that cycle. I think all of those elements for the US consumer was arguably overspending, fiscal deficit really high, corporate spending, especially with the boom around like technology and AI more recently. I think for the US, we were starting at, call it like a very elevated starting point. While when we go to Europe or you go to Asia, especially China, it was basically the mirror image of that, where in the case of Europe, like relatively depressed consumer confidence, high savings rates, deleveraging since 2013, real estate that has not picked up in over a decade, shock of confidence from the conflict in Ukraine, energy crisis, or what thought to be an energy crisis. So all of these drivers, don't know exactly where on the cycle they are, but in my opinion, we're much closer to a bottom than a peak. And then you go to China, and I think that's the extreme example where confidence, like rock bottom, savings rates, like literally through the roof since the pandemic and the closure of the economy that was much longer in that part of the world than it's been here, and certainly versus the US. Wealth effect shock from like the real estate slowdown. And for both Europe and Asia in general, it's not only the consumer that was starting on a very different sort of cyclical starting point, but it's also the government spending, where countries like Germany had been like very fiscally discipline for forever. And they suddenly have that lever to pull on to absorb a pretty big shock that we're going through right now with tariffs and global trade. While there's not that lever in the US, actually, it needs to go the other way. And that's why we see tariffs. That's why we see DOGE. Fiscal deficits unsustainable in all likelihood. But ultimately, we don't buy the economy. We buy stocks. We buy the market. And I think all of that was further compounded by the fact that you compare valuations, you compare expectations for the US market relative to Europe or relative to Asia. And again, it was like the polar opposite not that long ago. Like effectively, I think we peaked on that in the days following the Republican election win, as the rhetoric of the market was all of these policies are going to be phenomenal for the US, will support this US exceptionalism that we've been hearing a lot, and will be terrible for the rest of the world. And to me, that just catalyzed. I've taken a very different approach on that. This, I think, will be good for nobody. But at least if you start closer to the bottom of the cycle with low expectations and low valuations, you're likely to be better protected than if you start at the other extreme. So that's why I've been advocating for international markets for some time. I think based on a longer term view of where stocks sit relative to their normalized mid-cycle earnings profile, I think it's much easier to find opportunities there that seems mispriced, that we can take advantage of. And that's why I've been taking advantage of even before the US federal election. And I think there is likely more to go because we just inflicted a pretty big shock to an economy that may be at a position cyclically that's a little bit less able to absorb that shock as opposed to Europe or China that can use government measures, fiscal measures to offset that. And I think the market is slowly starting to realize that. The sharp move of the first quarter is in a way not expected. When we see change in leadership in the market, it tends to happen quickly. It's quite abrupt. I think we've seen that in the first quarter. I think that has the potential to last more than just 4 or 5 months here.
So something I've heard many portfolio managers say before is that at Fidelity, there is no house view. Depending on your investing goals and preferences, there are a variety of funds to match. Becky Baker and Kyle Weaver are the PMs behind Fidelity U.S. Growth Opportunities class, which has the strategy of growth with a valuation-conscious approach to investing in U.S. equities. Here, Becky explains why they are excited about the Magnificent Seven tech companies, and specifically with AI.
Mag 7 is obviously always a hot topic just because there's a lot of questions around valuation and, you know, they're as big as they are. Should we still be there? I know you and Kyle have some very passionate thoughts around the Mag 7. So perhaps share those with us and, you know, maybe just touch on the portfolio's largest holdings because there's a lot of overlap there.
Yeah. Okay. Well, I'll channel Kyle first because what he would say is
channel your inner Kyle.
Yeah, exactly. So Kyle would say, be careful because the Mag 7 is not all one story, right? And there is a lot of dispersion in performance. So that is a fair point. We talk about these stocks together because they're all big tech companies and they do have other things in common, but they don't all trade together. So I think that is a point of caution that Kyle always starts with. And I think it's a good place to start. So I'll channel him.
It's a good disclaimer.
Exactly. But I do think, I mean, there's so much incentive or it's so tempting to bet against the Mag 7 because they've gone up their exposure, they're bigger components of the index. From my seat, I wish that they were not so well positioned because my goodness, it would be easier to beat a benchmark that wasn't almost 50%, you know, companies that are this well positioned. But I think it's dangerous to bet against them. So it's about 50% of the fund that's in 6 of the 7 in a pretty sizable way. And I think part of what makes us, I'll say, like hesitant to bet against them and respectful of how high the bar is that they set for other holdings in the fund really have to work, you know, if they're going to beat these Mag 7 names. What sets the bar so high is, number one, these core businesses are incredibly healthy. So like when you look at them, I mean, the average of that group is growing revenue 10%, expanding margins, and that's even with this CapEx boom that's driving higher depreciation. And so I think the core businesses are healthy. I think they're laying the groundwork for the next wave of growth. So I think there are reasons to think like sort of the next chapter can be positive. And then they're well positioned in AI. They have tons of capital. They have engineers. They have huge user bases. And most of them, they're not all cheap, but some of them are not expensive. They don't even trade at a premium to the market. So I think that they're well positioned. And as much as we're watching for cracks, because we would love to be able to, sell out of one and put it into some new undiscovered idea, I think it's periods like this where they underperform by like a little. Yeah. And that's kind of when you want to be stepping in.
Etienne Jonca-Bouchard and Brendan Sims are up next. Their session covered the ETF landscape and Fidelity's ETF products. They'll touch on active ETFs versus factor versus passive, and also share insights to why the Fidelity All-in-One ETF suite continues to be popular, and how the All-in-One small allocation to Bitcoin can provide diversification.
Are you noticing trends going into like factor versus active versus passive?
Yeah, for sure. I mean, obviously here at Fidelity, we don't offer, other than our Bitcoin ETF and Ethereum ETF, which are more passive in nature, we don't really have any market cap weighted index type strategy, which is the definition of passive. We focus on strategic beta, factor-based investing, and then active. Also, to your point, we've got a lot more of our funds available in ETF series. And that's really been a growth segment in the Canadian ETF industry. Obviously, the large chunk is still in these, passive type strategies. But if you look at like the CAGR, if you will, over the past 3-5 years, so compounded annual growth rate, it's really actually accelerating on the active and factor side, which lines up perfectly for us. But I think it just shows that there's just more and more options out there for investors, for advisors. There's just more and more vehicles that you can use. And quick little cool nugget, actually, in February was the first time that we saw a month of flows in the US where there was more active ETFs bought in the US than passive ETFs.
We've seen a lot of flows into our all-in-one ETFs. I think over 50% of our assets on the ETF side of our business are in the all-in-one suite.
Yeah.
So talk to us a little bit about how we construct those ETFs and why you believe they've seen such great traction over the last few years.
Yeah, well, obviously, thank you to everybody in the room here. So far this year, like you mentioned, we've had, obviously very good flows into our ETF lineup as a whole, about 3.2 billion. Slightly more than 2 has been into the all-in-one ETFs, which are these ETFs of ETFs or funds of funds, if you will, where we're trying to build extremely core portfolios, very diversified, as much from a geographic standpoint, from a style standpoint, obviously with a different, getting exposure to low volatility names, high quality companies, momentum, value, et cetera. We combine systematic investing, if you will, factor investing with active management in certain areas, like our global small cap opportunities ETF is part of the mix. Our global core bond ETF is also there. That's actively managed. And the objective is to have these strategic exposures where we manage risk for investors, but we're not trying to take, tactical asset allocation calls. And, one of the benefits of that is we have consistency in risk profiles. So for investors that want to buy a 60-40, for example, well, it's pretty much going to be a 60-40 at all times. So there's a bit of clarity around that. The way that we rebalance these portfolio also allows us to really manage risk, but then also benefit from shifts in momentum. And the way that I say that is, since we've launched these portfolios, FBAL and FGROSS, or all-in-one balance, all-in-one growth, we've seen that they've consistently been able to achieve their objective, which is outperform kind of the passive ETF portfolios in this space. We've done it every calendar year. So even in a market like 2022, which was completely different than 2023 and 2024, which were a lot more similar, I'd say. It's kind of a testament of the construction process that we've put in place. Like last year, momentum was the main driver of performance in the portfolios. This year, it's low vol and value. So having this mechanism of staying close to the neutral mix allows us to create a really strong, consistent experience.
Brendan, there is a digital asset in these all-in-one ETFs, Bitcoin. So tell us a little bit about why we included Bitcoin in these all-in-one portfolios. And I think it's important to point out as well that Fidelity, I think we're the first company to add a cryptocurrency to a multi-asset product. So tell us a little bit more about why we did that.
Yeah, absolutely. And I think that I'll just start by saying it was last January that the US launched exchange traded funds in the digital asset space. So Canada had this landscape long before the US in that respect. And we just exercised that flexibility to essentially, the flexibility we have is to include up to 10% of a non-conventional fund according to national instruments, so an alternative into a conventional fund. And that's exactly what we did. So investors of the all-in-ones have anywhere between a 1% to a 3% exposure to Bitcoin. We do feel for those that are managing money that have clients that are asking about the space that it's an excellent vehicle to kind of get exposure to digital assets without necessarily bringing it onto the statement as an individual line item. That said, if you do wish to get exposure to the underlying, we do have FBTC, very much a leader in the digital landscape, leader on price, leader on custody. We do this front to back. There are no other sort of third parties involved. We have Fidelity Digital Asset Services out of the US who we use for the custody and safekeeping. So very much a leader in that space. But back to the initial question, which is why for the inclusion. And I think it goes back to the fundamental message that would be the argument for inclusion of alts in general. And that's that anytime you have the opportunity to bring a building block into a multi-asset portfolio that is less correlated, but longer term through the noise is going to compound at an attractive rate of return that helps meet objectives. So if that rate of return is on for example, it's 8 to 10. If something is going to long-term provide you something in that neighborhood, but be less correlated to the existing stocks, whether it's investment grade, fixed income instruments, investment grade, high yield, or the stocks for that matter, whether they are growth, value, or the various other factors, I think that that's a huge win for investors. And we do see that even just as recent as year to date, a lot of the damage in digital assets with the price of Bitcoin, which is most often quoted, was seen long before the turmoil that we saw in equity markets, be it 4 to 6 weeks ago. Digital assets, essentially, I'm not saying they priced it in ahead of time because that was by no means what happened, but they held up while equities were selling off because they'd already gone from like 108 to 85 in the months and weeks earlier kind of thing. But I think that investors just win by diversification.
So if you'd like to learn more about the strategies behind the growing lineup of Fidelity All-in-One ETFs, join us on Tuesday, June 3rd's Upside. We'll have an English show at 12:30 p.m. Eastern and French at 4:30. You can register on our investor webcast multi-reg page. So next we'll hear from Adam Kramer and Scott Mency about the power of Fidelity's deep research resources and how it supports their fund, Fidelity Tactical High Income.
Some may think because it's tactical high income, you're located in Merrimack, which is where the fixed income team is, but you're in Boston instead, and you have access anytime you need it to the 14th floor where all the company meetings happen. And because you're looking at it brick by brick, as you said, and all areas of the capital structure, you're privy to meetings that are questioning companies from all angles. It must be very, very interesting.
Yeah, I mean, it's terrific. We're like you said, we're in Boston. We're on the 12th floor, the High Income and Alternatives Group. Have around more than $100 billion of assets in our group across the full spectrum of income-oriented asset classes. What is it, 20-something analysts?
25 plus.
25 plus analysts that are looking for the sweet spot in a capital structure. Right. That's how I was trained as an analyst. If there's a bond, what's your opinion on the bond? If there's a preferred, what's your opinion on the preferred? Equity, the secured loan that Scott was talking about. And so it's a really unique analysis, but we also have access to all the equity research as well, which is just a skip and a hop away. I'm speaking with our emerging market debt team in our group, our real estate team. We have our international teams. There's so many companies coming in-house. And, for us, we have relationships with our management team. Just in this recent correction, we probably spoke to, all 10, either spoke or went to visit all of our top 10 holdings, speaking to our top 20 holdings. And that's how you gain conviction in these periods of volatility as well. And that's sort of what we walked away with during this down cycle.
As a Canadian, although you live in Boston, you also have a conviction in Canadian equities, and you're at about 13%. Could you talk about that?
Yeah. So this fund is managed always US dollar to US dollar. So when we go outside of the US dollar, we consider that currency risk, and that sort of eats away at our risk budget. But I like to step into currencies when there's an episodic opportunity. Okay. So Canadian dollar was pretty low in November. And then, comparing some of the utility companies, the unregulated utility companies in Alberta, for example, to the unregulated utility companies in Texas, there was a big valuation discount. So that's one good example. And this is where we have our analysts. We have a great analyst in our high income and alternatives group that made some really great calls on these unregulated utilities that eventually signed data center deals in the U.S. And we said, hey, why don't we take a look at these companies? And that's where we actually found some interesting opportunities. And also there's a lot of negativity with regards to the Canadian dollar now, for good reason. There's not a lot of visibility, but now with the election over, maybe some of that visibility comes back. So it made a lot of sense if you could buy a bottom-up security selection story at a discount where there's a catalyst, fundamental reason to own it, and then you also have some currency opportunity as well. So, and then we started to look at some other areas as well, and probably like you said, around 13% of the fund in Canada. And it's not only equities. I mean, many of these top ideas start off by looking at the bond. I mean, we've had a bunch of Canadian companies in the energy space and the infrastructure space that have issued US dollar bonds. We've looked at it in our group and we say, let's take a look at the equity. This isn't a bad idea. So that's one area that we hold. And you'll see in our top 10 holdings, we own a couple of the Alberta utilities, which I consider to be very deep value at this point, with catalysts if we ever did see some visibility with regards to that market and data center deals down the road.
The final highlight from Vision Plus today features portfolio manager David Way and his path from analyst to portfolio manager and the launch of his fund, Fidelity Long-Short Alternative Fund.
2008, you came to Fidelity as an analyst, and you had a number of years going through different sectors, as Maddie talked about. Analysts are judged on many things, but in particular, how well your buy recommendations work and how well your sell recommendations work. And it creates a chart that looks like a scissor. If it's a knife, you're not doing so well. But if it's a scissor, it's a really good thing. And that was a bit of foreshadowing for you because you did very well on both aspects of that. I'm sure you were thinking, I wonder if we'll ever long and short at the same time. Because at the time, Fidelity really didn't have any shorting ability, did it?
Correct. It was a 10-year program, and it's common for analysts to cover all the different sectors of the market before becoming portfolio managers. I think you've heard that a couple times today. And most of the time, so quantitatively, your compensation is driven by how well do your buys do, how well do your sells do. And with a long-only portfolio manager, really there's two types of stocks. Stocks to own, which is your buy-rated stocks, and stocks you can ignore, everything else. And for me, really the genesis of getting to where I am now is that when I was covering commodities, I covered forestry stocks when there was a Sino-Forest short report, which was accurate and sunk the company. And so for me, talking to the short seller who developed that report, I actually talked to him a few weeks ago. I'm still in touch with him. Really sort of, for me, the light bulb went off that this is like, wow, this is like really interesting. Like, what's the difference between a stock that we could ignore, something that's middling, not as good as what we own on the long side, and what's something that's a short, what's something that's going to really disappoint people? And for me, it was just kind of following my passion. And fortunately, the opportunity opened to do it in a fund.
That is awesome. Now, Brendan was just up a session ago, and he was talking about the fact that you've been running this portfolio, long-short alternative, for 5 years. Many of us have heard advisors say, you're the best kept secret on Bay Street. I'd say that's less so now at $1.4 billion. It's also amazing to me the number of advisors who have said, I'd like to have a larger alt sleeve in my portfolio allocation, and they're working towards that, and they see you as fitting that bill. So talk to us about the strategy of long-short alternative.
The fund consists of two individual portfolios that are working together to solve the objective of, how do you generate attractive, equity returns, better than benchmark with lower volatility. The long portfolio, and really from a sizing perspective, it can be up to 150% gross, 50 short, and really 150-50, yeah, sorry. And really what that means is for $100 of client assets, I could be long $150 of stock and short 50. I've generally lived in, around the, 130-30 range.
Okay.
Net exposure of 80 to 90%. So really what that means is I have stayed around 80 to 90% exposed to markets and really trying to capture returns from the short portfolio, delivering returns when things are bad. And also the scissor chart you talked about, over time, there's also this less correlated return available from just having longs outperform the shorts. So as we look ahead, there's a lot of uncertainty. And from the perspective of the long portfolio, there is some uncertainty. And of course, it's the portfolio manager's job to manage through that. But what gives me a lot of comfort is that every day I know that I can walk into the office and be attacking the market through one of these three strategies. And only one of them really benefits from the market being up. If the market is flat or down, there's a part of my fund where I can be excited about, what's going to happen today.
You work in a team environment. It's your portfolio, but you work in Toronto with a huge team of people. There must be some jealousy from some of your peers. The fact that if it's a certain type of market, you can go short. If they're long only, they must look to you as having real great versatility.
I think you have to be a bit of a special personality to enjoy shorting. Like nobody really wants to start their day hunting for bad news. So in some sense, some people don't enjoy looking at shorts and only want to think about what can go right. But it is true that during periods of volatility, it's a bit easier for me because I know that I'm going to have part of the portfolio working. And the thing that I like about it is in those times it allows you to operate from a position of strength. So if you could think about early April, the fund, I actually kind of thought tariffs were coming. And so the fund was well positioned for the news that really shook markets in early April. So I came into the office during the first week of April hunting for stocks to buy. Like what stocks have been really beaten up where we can now either add to the position that I have and make it a full position, or bring new names into the fund where perhaps I was worried about tariffs, but there was a price that I was willing to pay because I think over 1 to 2 years, these could be really big stocks.
I hope you enjoyed all of those segments from Vision Plus. As mentioned, for more, you can find each clip as a full video podcast, available on YouTube, Spotify, Apple Podcasts, and more. Please keep an eye on your email to not miss an invite to the next episode. So, thank you for watching today, and I hope you'll join us again on the Upside. I'm Kyle Sharapata.